Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about the best way to review your trades. Now, reviewing your trades is something that is very important, and a lot of people, especially newer traders, should be doing. It's a way that you can kind of go through and catalog your trading, see how you did, see what your thought process was, and really just kind of cover everything that you need to know to learn from the trade, win or loss. Now, when we're talking about reviewing trading, this is going to be more about the journaling side of things. But in reality, you're going to be doing review and journaling at the same time. That's kind of the mindset here. So first of all, journaling. What do you use for your journal? Well, a lot of people choose to do this by hand. They love writing in a notebook or whatever it is, but manually writing it down, each one of these steps. And that way you can actually keep these for longer. You don't accidentally delete the file off your computer. Your computer goes down, then what? Now, that is kind of nice to have those as a hard copy. It's something you can look back on. You can review your trades while you're flying to your grandma's house. You can review them in pretty much anywhere you want. You don't need internet or any of the other stuff to do. Another way to do it would be a cloud-based application like Sheets from Google. The web address is Sheets or sheets.google.com, something like that. And on that, at least with that, you can't accidentally delete it, right? It's a cloud-based platform. But one way or another, taking a journal and reviewing your trades and understanding those trades can be a huge, huge benefit. Now, first of all, breaking it down. And these are just the generics. You can go a lot more in depth. You can go a lot less in depth. I don't necessarily know I would want to go less in depth, but there are a few major things that we want to keep our eyes on. So first of all, the journal, right? What do we need for our journal? So for the journal, there are a few things that we want to keep an eye on. First of all, the date and time, right? What time did you take the trade? On what day did you take the trade? It's going to be kind of hard to review your trade in the future if you can't go back to a specific time if you don't know when that happened. So make sure to catalog the date and time as best you can. Now, along with that, you also need the ticker or the symbol, if it's, crude oil futures or something like that, or if it's Microsoft. You need to know what market you were trading and at what time. You also want to know your entry price. And along with your entry price, the direction. Which way were you going? Were you long or short? Really break it down so you can look back. And really the idea of this is so that, not necessarily, okay, well, this is important right now, but if you need to look back at that, you need to be able to reference exactly when this trade took place so that you can visually see on the chart what happened. Now, along with direction, this is where we can start really breaking things down. We have our risk versus our reward. What was the risk and what was the reward on the trade? Were you looking to risk 10 to make 20? Were you willing to risk $100 to make $150? What was kind of the risk reward that we were going with on that specific trade? And we also want the perceived probability. Now, the reason I say perceived probability is because, well, you never know what the probability is until the trade finishes. But the cool thing you can do is you can categorize these perceived probabilities and look back on them after X amount of time and say, okay, my perception of probability on that trade was 63%. But in further review, after taking this trade multiple times, I can actually see that it was 57%. Now, that may not seem like a big difference, but in the long run, that's a huge difference and something that you need to be able to look back on and be able to figure out. Now, your perceived probability is not the next, which is the actual probability. Right? Now, you won't know this until the trade is done, but the actual probability of the long run. Now, this is where you're going to want to get a little bit creative and try to create different scenarios. This might be, let's say as an example, you're buying the lows of a channel. You would categorize this as a channel low buy or a channel high sell or something like that. So somewhere along in here, whether it's the way that you're saving it or where maybe you keep it in a separate folder or you're just documenting it in different journals or different pages or different sections of the journals, but make sure that it is in the correct section. Categorize the trade. Right? So you need to categorize the trade so you know what the trade was, why you took it, where it was, maybe it was a type of pattern or whatever it was, but you can look back on it and this will help you on your perceived probability and your actual probability. Now, along with that, going a little bit further, we also want to know, obviously, what was the result of the trade, right? Was it a win or a loss? right? That's obviously important. Along with that, the result of the trade, but we also want to know the size of the result. And then with the size of the result, this one kind of comes along with it, but the percentage of result. And you can think of this as your ROI. So if it cost you $1,000 to put the trade on and you made $1,200, well, you made 20%, right? That's your ROI. That's your return on investment. Now, different markets will have different requirements for this, because if you're trading a stock, it's at face value, right? If I buy Amazon and it's $1,700, it's going to cost me $1,700. So ROI is a lot easier to figure out. If you're talking more along the lines of, let's say crude oil as an example, well, you've got margin and you've got all this other stuff to consider. In those types of situations, rather than using an ROI calculation, you can base it off of your risk. So if your risk ROI was $100 and you made $220, that would be what, right? Well, that would be a technically 120%, but realistically your ROI, your risk was 100, you made 120 on top of what your original risk was, so you factor in that calculation and you made 20%, right? So you can use a slightly different type of calculation when you're talking about those markets because, well, you don't really have a choice. It's just sort of the way that it works. It's not a face value type of cost. Now, the percentage of the result, this is probably the most important part of the entire thing, but notes and thoughts, including feelings and emotions, okay? This is very, very important. The notes and thoughts on the trade, this can be something as simple as I bought at the channel low. I believe they had a great probability. It lined up with this. It lined up with that. And then kind of categorize your feelings through the trade. Well, it didn't quite go up right away. Made me a little bit nervous. And really dig into the emotional side of things to understand you as a person. Going in and further understanding you as a trader can be a huge benefit. But if you're not categorizing these things, you won't know that you're feeling that. Right? If you're feeling anxious because it went in your favor and then went against you and then it went back up again, and later on you find out that trade would have been a loss if you just gotten out, but you were feeling a little bit uncertain. You don't know those things unless you're actually actively tracking them. And by actively tracking them, you in turn understand yourself better as a trader, and you can quickly develop your trading style in a lot more, really just a lot faster than any other type of situation if you're not categorizing these things. So really digging in and not just going, okay, channel low, check, I bought it here, check. No, really go in further and say, okay, I bought it at the channel low, it lined up with, 50% Fibonacci level, and it had a double bottom, and this is a retest, and I was feeling really good about this trade. It looked really good. The perceived probability was right around 65%, but I felt as though it would have been higher, and then, put a little pause. As the trade's going on, you might not be able to type it in as the trade's going on if you're a faster scalper as an example, but remember those emotions and recall them and say, okay, during the trade it went in my favor a little bit and then started pulling back to break even. I started getting a little bit nervous and I wanted to move my stop a little bit, but I didn't, and really dig in and further understand you as a trader, because you can look back at this and you may look back on it in 2-3 years and kind of laugh at it and like, what was I thinking, but you won't know that growth. You won't know how far you've come unless you start looking at these types of things as well. And more importantly, you further understand yourself as a trader so you can better keep yourself disciplined because you understand the emotions that you're going through and you know how to dismantle them or nurture them if it's a good emotion. So very important to keep that in mind as well. Now, those are the basics. You can go a lot further into journaling. You can do a lot more in the journaling aspect when you're really digging in. But those are the big things that I would start with. And that's going to allow you to really kind of review the trade, understand the trade, and understand how you felt during that trade. Along with that, it will give you the capability of going back and kind of tweaking your perceived probabilities, the actual probabilities, understanding the emotions that were going on during the trade, and a lot of other really good things that you might not be doing at the moment. Something to think about, something to consider, and definitely something I would highly recommend for new traders, experienced traders alike, especially new traders, getting into the habit of journaling and reviewing your trades at the end of the day, not beating yourself up if it was a losing trade and saying, oh man, you're a garbage trader. And no, you're going in and you're just really just kind of dismantling the trade and saying, okay, I took it here, I took it at this time, this is why I took it, these are my thoughts and feelings on it, this is how it ended up, etc. right? It's a really good way to review your trades in a neutral mindset, so you're not beating the crap out of yourself if it was a bad trade. You're also not pumping your ego up if it was a good trade. You're taking a very analytical approach and understanding what happened. Hopefully it's something that you find interesting, useful, and all of the fun stuff that we always go into. As always, regardless of what your approach to journaling is, whether it's a lot more in-depth or whether you're not doing it at all, you might want to potentially look at adding or, start doing it if you're not doing it already. That's going to do it for this one. I hope you found it useful. I hope you found it interesting. As always, underneath the video, throw a thumbs up on the video so we know that you like the content. Along with that, make sure to subscribe to the channel so you don't miss anything important, and click the notification bell icon to the right of that so that you're notified every time one of these videos comes out so you never miss anything important again. I hope you had a fantastic trading day today, and until the next one, we'll see you all then. Thanks.